Welcome back to the Diplomats Network, everybody. You got your boys here, Lanny and Bert, the Dividend Diplomats. We both have belly full of turkey, belly full of stuffing. We're recording this Thanksgiving
Well,
night.
not
Let's,
much.
we are talking about a stock that is down 27% in the last month. It is down over $100 per share.
Wow.
Question is it time to buy this $584 billion market cap giant?
Guys, hit that subscribe button. Give this video a thumbs up. We hopefully are back here on all of our social media networks. Bert's got a stock here to talk about here on the channel. It's down $100, guys. Pretty incredible because they've had quite the run up and now they're having quite the run back down. But they are still up 255% in the last 5 years. We're going to do a little bit of background on what has occurred over the last few months from the news releases, guys. But it's all about, earning, saving, and investing here on the Dividend Diplomats channel. So hopefully this is a good stock to keep an eye on.
So again, do your own research, everybody. That's the key of this. We're sharing this opinion, but it's just that. If you like the stock, buy it. If you don't like the stock, don't buy it. Most importantly, you got to do your own research. That's going to be a disclaimer we start saying more and more, especially as we keep barreling towards 2026. So who are we?
Exactly.
Yes.
Exactly.
Who are we talking about today?
Oh,
Oracle ticker
baby.
symbol ORCL.
Larry Ellison, watch out.
Yeah, they've had quite the 3 month journey. They set the world ablaze back after they announced strong earnings, a massive pipeline. It sent the stock price soaring. It sent it up from in the high 100s all the way up to over $300 per share. Their 52-week high as we speak is, drumroll please, I'm pulling it up. Their 52-week high is $345 per share.
Jeez.
However,
Wow.
jitters and AI fears have sent the stock back down. They're currently all the way back down to $204.96 per share.
Back to earth.
Yeah, back to earth. What's fueling that? Well, some cracks in the AI bubble popping are starting to emerge. You hear the talk that a lot of these companies are just the same five companies are spending money amongst themselves. So what happens if the spending slows down? What happens if the spending stock? You have cash going from Nvidia to Oracle to Broadcom, back to Oracle, back to Broad. Like, it's just a circular. It's like a nice little circular reference.
Yeah, it's very funny. And obviously they're the big players are dealing with the big players. So there's definitely big concerns about who's actually going to be the one taking in the most cash here. But then it's not even just that, though, Bert. You've really highlighted big time with debt. Everybody is just doubling down, adding, tripling down on their debt loads to help fund the AI investments right now. Bert, I think you mentioned that Oracle also raised $18 billion with the deal with OpenAI, and that's just adding more
Yeah.
strain on the balance sheet, possibly.
Yeah, I thought that was interesting. In this article I was reading, it was saying that tech is doing something that's uncharacteristic. You've thought of these companies with the strongest balance sheets, with massive cash
Yeah,
piles, and now they're starting to lever up a little bit. And you're seeing that in the credit default market, credit default swap market, where you're seeing very high spreads, very high premiums for Oracle. I think Oracle was the one that shot up the most. Pricing for those swaps were high, which even led to more fears about debt loads, more fears about the AI debt bubble cracking. So it was just an interesting thing where, if you think about it, now that you're not just sitting on cash, you're not paying cash for a lot of these investments. AI is going to take a lot of capex. We all know that. Now, if you add debt to the equation, though, if the bubble pops, if revenue slows, that debt doesn't slow down. That debt doesn't magically disappear. You're in a much different financial situation if you have a huge debt burden, and the stakes are a lot higher to keep the AI machine flowing.
now granted, there's plans that rates could and should keep coming down, so the cost of debt may continue to decrease here in the short to midterm here over time. And again, I apologize to you guys. Got a little bit of a congestion going on, sore throat, plus a headache and all that stuff. So just
Yeah.
pushing here right now, guys. Um, But Oracle, they've been a beast, guys. They've been such a strong company because hey, they're not just AI, right? They're not they're in such big infrastructure in large companies. We're talking their ERP and ERM and core systems that Oracle provides. Bert, I don't know. In your workplace, do you guys use any Oracle products that you're aware of?
NetSuite.
Boom,
And
the biggest one, right?
the biggest one, it's our accounting system, and it's not great. It's not technologically advanced, but it gets the job done. It's very consistent. It's very solid. So you get it. But pricing's going up. They always try to jack up our pricing. It's a common story that everybody tells, especially with an Oracle product.
Oh yeah. So Oracle, they've got like some bread and butter
Yeah.
products and services, and then now they're just hopping on that AI rocket ship right now.
Yeah. So jet fuel from there. Um, the one last piece of news I will note before we run into our screener, Lanny, is Michael Burry, as everyone knows about the tech. He's accusing tech giants of overstating their earnings by stretching out the useful life of their assets,
Oh yeah.
which I thought was always hilarious, saying that you're depreciating over 5 years instead of two, meaning depreciation expense is lower than what it should be. And companies are really hiding the true cost of some of these AI investments in AI technology. It was just noteworthy because Nvidia made the headlines, but Oracle was right there sitting behind them, saying that they're stretching out the useful life. So,
Hey,
yes,
we'll have to see if there's some any impairment charges. Obviously, their auditors have to sign off on something at some point.
non-cash, baby. It's a non-cash item. And
Non-cash, but
you don't want to
non.
get you don't want to mess around with this. It's obviously something to be concerned about, and we're making light of it because from this. But if it's true, that sucks. If it's not true, it is what it is. So Oracle, some headwinds they're facing, but to your point, Lanny, you called out something very great. They have a lot of great legacy systems. They have a lot of great cash. They're not fully dependent on AI. Their growth, that rocket ship might be dependent on AI, but they still have recurring revenue and recurring cash flows from their core business, which is always a good position to be
Absolutely, guys. So what we do here, if you're not aware, is we run these stocks through the Dividend Diplomat stock screener, focused on the PE, the payout, the dividend growth, and the dividend yield. So, Bert, we're filming this here. It is actually Thanksgiving, guys.
in.
Bert and I were like, you know what? We're gonna film it here on Thanksgiving night just to make sure we have videos for you guys. They were at the close of November 26th, the Wednesday, $204.96, Bert.
Going, wow. So their earnings per share, forward earnings per Seeking Alpha, $6.82. That gives you a PE ratio of 30, which is higher than the S&P 500. Higher,
30.
but it's lower than where it was a month ago.
You don't say.
Yeah.
So they pay that 50 cent per share per quarter dividend, or $2 a year. Very low and safe dividend payout ratio at 30%.
Yeah. Their dividend growth history, 14% for 11 consecutive years. So very solid dividend growth.
Wow. There you go, Oracle. That's what I'm talking about. A 1% yielding stock. Again, down 27% in the last month because they're down $100 guys. 584 billion in
Mm-hmm.
market cap, which is wild.
Yeah.
Wild to even think that they were well even above that when they were trading well over $300 per share. So that's Oracle stock, a 30 PE, a 30% payout ratio, a 15% dividend growth rate with a 1% dividend yield. I'm not liking the 30 times earnings.
No, unfortunately, I am not either. It's still expensive, even though it's come down 27%. I mean, it seems like a far stretch, but even if you get it, if you can get it closer to say like a 175 to get you a PE closer to 25 or 150, God forbid, to get it down to a PE of 22.
Another 20, yeah,
If
right.
it ever gets down there, it's an opportunity I'm not going to pass up on. I will definitely grab some Oracle. And interestingly, um, it was at this point, Lanny, back in May. So these values are happened just 6 months ago. If it can return back to those levels, I'd be interested in Oracle. But unfortunately, I think even though it's dropped, it's not a buy right now.
What about you guys? Are you guys looking at Oracle stock? Do you own this stock? Are you using this as a growth stock or an actual dividend growth stock? You'll have to let us know in the comments, guys,
If,
below.
Sorry if you haven't already, subscribe to the channel. Give this video a thumbs up. And remember, you're either with us or you're against us, Jack.
That was Bert and Lanny from the Dividend Diplomats. Over and out.